Good evening, everyone. It's Eric with Option Edge, and we're looking at Walmart this evening. If you go to my Twitter, right before market close, I put out this tweet of what I was doing in Walmart. I'm doing a bullish pre-earnings diagonal trade. So that consists of me buying to open the November 19th $150 call, and then coming back and selling a shorter dated call. So November 12th, and it's out of the money. Okay, so this is what a diagonal is. The 150 is at the money. The 152.5 call is out of the money. Okay, so let's see how that looks like on Robinhood, what that type of trade looks like. And if you look at my other video, I talk about my most successful trade, and I talk about that, and I'll link to it. But basically, what we're doing, this diagonal, it's a pre-earnings diagonal trade. Okay, so Walmart has earnings on the 16th. Okay, so if you haven't watched that video, go ahead and watch that video because it's going to explain some of the concepts and ideas that I'm going to be going over here. But like I said, earnings are November 16th. So basically, what we're going to do is we are going to buy a call that has earnings in the same week, but earnings occurs before option expiration. So earnings is the 16th. We want to buy the 19th call. All right, so we're going to select that. Now we're going to sell the more out of the money call, shorter dated option. Okay, and select, and I'll show you which strikes I'm picking. So this is about the 25 strike. What is this here? That's the 12. Yes, we're going to go with this one. Sorry, let me go back here and show you. We selected this one. This is about the 50 strike. Okay, so if we go, and I'll show you the main reason why I'm picking out this strategy. So if we look at my CML Viz back tester, this is looking at a 40 delta and a 20 delta. So buy to open the 40 delta. That's closest to the 14-day expiration options, and then at the same time sell the 20 delta that has a 7-day, closest to 7-day expiration. So that's what we're doing here. That's exactly what we're doing here, and it doesn't have to be perfect because the back testing software just rounds to whatever the closest date is and also the closest delta. So we have a 49 delta. The next delta is, let's see, 36. Okay, I guess we could have gone. The idea is though that if we were to select this delta here, this is about so this is the same strike as this delta we're selling here, and we'd end up getting a calendar spread rather than we would have gotten a calendar spread rather than a diagonal spread. And let me show you what that looks like. This is a calendar spread. Basically, you have a much smaller room to profit here, but if you do pin the strike, you profit big there. But that's not what we're trying to do. Like I said, we're selecting the 150 call on November 19th, and then we're buying that, and then selling the 152 call on the 12th. Okay, so it's about 40-25 or 50-20 the deltas. So that's what I did, and let's just take a look at. So we got here so Walmart right now is a little bit oversold. So that's one of the my one contention with it. And then let's see what else. So that's and the last thing, I just want to show you what this looks like. I like to use the trading. Tasty Trade has some interesting software that shows you, your net theta decay and your net delta, the price of the option, current IV rank. So this is a high IV rank, and it shouldn't drop as we go into earnings. It should only pick up, if anything. And then we have our P50 stat, which means it shows us our percent. So it says 96% of achieving a profitability of 50%, which this seems like extremely high. I'm sort of a little bit skeptical about this. Sometimes when you have, since it is a diagonal trade, the expiry dates are not the same. So sometimes that confuses software. But anyway, this is my trade. And like I said, if you haven't reviewed the one video where I talk about my best trade ever, I go over why this is such a good trade, because we take advantage of something the market gives us, and that's the whole idea of the theta paradigm, where we're getting short an option where it exponentially decays very quickly, and then we're getting long an option where the time decay is much, much, much less. So basically, we're buying we're getting bullish without theta decay, and that's like one of the so that's going to increases it's going to increase our chances of winning by a lot. Okay, so yeah, that's the trade. Like always, like and subscribe if you're enjoying this stuff. And as always, this is for educational purposes only, and not to be meant to be taken as any type of advice. All right, take care, peace out, happy.